Okay, so this is the last part of chapter 6. This is part 3. And by the way, we're just going to go over LIFO and FIFO, average cost or weighted average cost method. You can review in the textbook. It's going to provide a result that's somewhere in the middle of these two methods, and it's really just going to smooth out the effects of both LIFO and FIFO. It's a little bit different technique, but really all it's doing is just taking a weighted average of the price per unit of what's available for sale at the point in time of each sale. So what you're going to do is look at everything that's available in terms of the total cost, divide that by the total units. You'd get a weighted average cost per unit. And then that unit is just applied to the number of units sold. And then that's your total cost of goods sold for that particular sale. So take a look at that in the textbook. And I think that's fairly straightforward. But really I wanted to focus on just some of the particulars or nuances, I guess, of FIFO and LIFO. And it's important to understand what's causing those differences and why it's important to make note of that, and why one method might be better than another, and why one method might be used more often than another, and an interesting sort of result of using these two different methods. So first of all, we touched on this at the end of the last lesson, but kind of running out of time. But which method produces the highest profit and why? And we can see from the previous lesson that in fact, and here I'll just scroll, I'll just scroll down, but you can see that if we look at these two scenarios, we can see that this is the FIFO scenario. And this is the LIFO scenario. And you can see, in fact, that gross profit is higher for LIFO than for FIFO. And the question is, which one does produce the highest profit and why? And I think if you take a look, obviously FIFO is going to produce the higher profit, but only in a certain situation. And maybe you could just pause and think about what that situation might be. But FIFO produces the highest profit, but only during a period of rising prices. And I'm talking about the costs of the product that they're purchasing. So if prices are rising, FIFO is basically including in cost of sales the lower cost earlier prices. The lower cost earlier layers is what's included in cost of goods sold. If the lower costs are in cost of goods sold, then obviously that's going to make for a higher profit. LIFO would just be the opposite. LIFO is going to include the later, higher priced layers in its cost of goods sold, and therefore the profit is going to be lower. So which method is the most common and why? Well, believe it or not, even though physical flow, we talked about the fact that FIFO is going to be obviously the way you're going to run your business. From a physical flow of goods, you're always going to want to run your business on a FIFO basis. In other words, the first products that you purchase are the first ones that you're going to want to sell. You're always going to want to make sure that's the case, so that you don't have old product that sits on the shelf. You want to make sure that you're constantly turning your products over So the first ones that come in are the first ones that are going to go out. But from a cost flow perspective, believe it or not, LIFO typically is the most common, especially among small businesses. So LIFO would actually produce lower profits. Now you might ask yourself, well, why would we want to show that? Why would we want to show lower profits? Well, the primary reason, of course, would be taxes, to minimize taxes. So LIFO produces lower profitability and thereby minimizes taxes. Now, in most GAAP financial reporting, there would be a footnote that would describe the fact that the firm is using LIFO accounting, and so that users would understand that perhaps the earnings would be somewhat depressed because of the fact that they're using LIFO. So users wouldn't necessarily penalize the company for reporting lower income, because they would know that LIFO is having an impact in the profitability and is causing that profit to be lower. So with the full disclosure of the method that's being used, the firm would probably not be penalized by investors because they would understand that, in fact, the company is aiming to reduce their tax bill, and that's why they're reporting reduced earnings. So that is one reason. In terms of being able to switch between the two, you cannot just switch back and forth between the two for the purposes of manipulating your tax bill. So if prices were to decline, for instance, you couldn't just switch back to FIFO to reduce your tax bill. You can maybe make one switch and it has to be justified, and then you have to stay with that particular method for inventory valuation. Okay, so you might think, well, okay, fine, we're going to report lower profit, but that's not good. Why would I want to have lower profit? That's just going to hurt me. Well, the fact of the matter is that it really doesn't hurt you. That this method is purely for accounting profitability purposes. It has nothing to do with cash flow. So if you think about it, the cash, ultimately it all boils down to the cash that comes in and the cash that goes out. Ultimately, a firm is going to collect cash and pay cash, and that's the key to any business. So if you look at it purely from a cash flow point of view, ultimately what's coming in, and let's say this is FIFO, and let's say this is LIFO. Okay, so what's coming in for FIFO is the $100 of sales, and the same thing for LIFO. They're receiving $100 from the sales, from what we discussed above. What's going out is the purchases of inventory. So if we add up the 16 that we had in beginning inventory plus the 18 plus the 28, that's a total of 62. So ultimately $62 of cash went out. But the same thing for LIFO. We had the same amount of purchases for LIFO. So 62 went out. So there's a net cash inflow under FIFO of $38. And a net cash inflow under LIFO of $38. So FIFO and LIFO, the cash inflow, the net cash effect of all these inventory transactions, purchases and sales, is a net $38. Oddly enough, though, if we look at just the gross profit, or the profit, we'll call it just profit, the profit under FIFO is 45, but the profit under LIFO is 42. So this is a very unusual situation where simply by deciding on one of the different inventory methods, you can actually change or distort or even manipulate your profit, irrespective of the fact that your cash flow is exactly identical to what it would be under both methods. So it's kind of a free lunch in as far as why not save yourself taxes. In this case, let's say these were millions. You'd save yourself $3 million of profit, taxable income. If your tax rate, let's say, was 1/3, that would save you $1 million of tax a year. But you wouldn't be sacrificing any cash otherwise. Your cash flow is exactly the same. So why not save the $1 million of taxes when everything else is exactly the same? Simply by choosing LIFO over FIFO, you've reduced your tax bill, yet everything else is exactly identical. So it's kind of a unique situation in accounting where you actually do get sort of a free benefit. All right, so then that leads us to our final question. Which method provides the best matching of revenue and expense? Okay, now this might seem a little counterintuitive, but the best matching, and I'll let you think about that for a moment. I guess you could pause it. But in addition to reducing taxes, why would the IRS allow LIFO? If you think about it, the IRS, it would be counter to their interest to allow LIFO. Now, one argument in favor of LIFO would be that, in fact, it is the better matching of revenue and expense. And the question is, why is that? All right. So if we look up above, just as an example, let's look at these transactions, okay? So for instance, let's look at these and let's pretend these are millions of dollars. So let's look at this sale, okay? So under FIFO, okay, this sale here. So under FIFO, most of the sales dollars are attributable to the first layer. So let's say that this was, the beginning was based on 1/1, and this sale, let's say, occurred in December. Okay? I'm sorry, this purchase occurred in December, and then this sale occurred in December. All right? So here what you have is you have a sale that occurred in December being matched with a cost of goods sold that includes December, a purchase, and January inventory. Okay? So again, a December sale that's matched with December purchase and January inventory. If we look at LIFO, on the other hand, what do we have? We have a sale in December that's matched mostly, in fact, all of the possible units are December purchases, and then whatever's left we had to take from January. Here, though, almost all of the sales units are from our January inventory. So basically what's happening is that the reason that LIFO is a better match is it matches today's sale with the latest costs. So what you're doing is, by using LIFO, you're including the latest costs in cost of goods sold, and that's being matched with sales. And you want the latest costs being matched with the latest sale. That's the better matching. You don't want the earlier cost being matched with the later sale, because those earlier costs may not be representative of what you can buy the product for anymore. So hopefully that's helpful. I know it's a little counterintuitive, but LIFO actually is the better matching of revenue and expense.